Well, I think obviously looking at what's happened this morning, there was always this fragile recovery. Investors didn't really buy into it. Certainly, professional investors didn't really buy into it, and they'd gone too far too fast. So any sort of negative data was always going to be the market pretty vulnerable. And really what we're seeing this morning is some of the economic reality coming home to roost, that it is going to be likely a slow, prolonged recovery, and it's going to take time. And the market had got way past that and was looking really into the recovery stages already. And we've seen a full market cycle almost in the space of 3 months, which was crazy.
And yet difficult to walk away because we know that central banks and governments are willing at this point to continue to provide stimulus and financial support. But I get the sense from what you're saying that you wouldn't be buying the dips here.
No, I think it's a time to be cautious and patient as an investor. I think in terms of obviously the huge amount of stimulus, that will clearly help markets. And what that's done is put stability back into markets, which has been incredibly helpful clearly, and means that ultimately to test new lows and deeper lows, it would have to be a pretty terrible set of events to get there. But I think stimulus can only do so much, and what we see often in this circumstance is that ultimately the economic realities take a lot longer to play out than the market had been assuming. So even with all this amount of stimulus and this huge amount of money flowing at markets, both at a fiscal and monetary level, we think it still makes sense to believe in the market mechanisms and wait until you get to more attractive levels for equities before putting risk back into portfolios.
Roger, I was looking at your strategy, though, being balanced value versus growth. And what we saw in the last week or two was this broadening out in the market rally away from growth stocks, where value stocks started to rise. We heard a warning this morning from Patrick Armstrong, one of our guests, saying that he's concerned about investors picking up too many value stocks and they might be a little bit too rich at this point. What do you make of the risk now? Because what we've got is a very long economic crisis coming, and that does not benefit value stocks.
Absolutely. I think it's incredibly difficult in terms of that call yet, and going more into value. I think value by its nature and the spread between value and growth in terms of valuation, it probably got far too extreme to some extent, and I have a lot of sympathy with that, as from the point of view that value stocks look cheap compared to growth stocks. However, in this sort of environment, there is absolutely no catalyst for value stocks. You need a lot more supportive growth environment really for value stocks to start to perform. And also, I think one nuance in this maybe is investors were far too much into cyclical value. There are value sectors that have a little bit more resilience, defensiveness to them. Obviously, telecoms, utilities. We probably know why these are value stocks. They don't have a huge amount of growth. But I think the skew in terms of that cyclical value was far too much, too fast. And I think really maybe one for the longer term, but it also highlights, unfortunately, the risk at the other side is that maybe the reality of the situation wasn't that value stocks became cheap. It was actually that growth stocks probably started to become a little bit too expensive.